A merchandiser calls its revenue sales. In other words, we don't have the account fees earned. We have a new revenue account called sales. We don't even call it sales revenue. We simply call it sales, but it is a revenue account. Being a revenue account, it has a credit balance. When do we record sales? Well, that sounds pretty simple, doesn't it? You know, in my family, I told you we go to Walmart every day. It's just sad, but it happens. Somebody in my family goes to Walmart every day. And from Walmart's perspective, it's pretty simple. When I go to that checkout line and I push my buggy through there and I swipe my card, at that moment, Walmart records the sale. It's pretty simple then. But let's suppose I'm a business that I sell maybe furniture or something like that. So, and I have a customer call me today and say they would like a quote on a certain item. So if I give them a quote, I simply tell them, here's what the price would be if you were to buy that from me. So today I give them a quote. Tomorrow they call me and say, yep, I like it, I want it. The next day I send them the stuff. It's across the country, so they don't receive it until the following day. That's 4 days right now. And then they pay me for it the next day. Already right there I have 5 days involved, don't I? 5 potential different days on which to record revenue. So when do I record sales? Well, I'm going to give you the short answer right now. We'll talk about it later on. But the short answer is we record sales when legal title to the goods passes from the seller to the buyer. And that comes in dealing with something called terms, and we'll talk about that more when we get to the section where we talk about freight. But to record making a sale requires not 1 but 2 journal entries. 2 journal entries, and they are for 2 different amounts. The first journal entry is to record making the sale itself. It records the sales revenue. Now, how this entry looks depends upon what type of sale it is. Is it a cash sale? Is it a credit sale? Or is it a credit card sale? Those would look a little bit different. Regardless of how the sale is made, though, this entry's amount is going to be what we're selling the item for. So let's suppose it's a cash sale. I sell you something for $100, you pay me in cash. What do I have more of? Cash and asset goes up with a debit. What else do I have more of? Sales, which is revenue, goes up with a credit. So debit cash and credit sales, because that's my revenue account. What if it was a credit sale? In other words, the person promises to pay me later on. What do I have more of? Accounts receivable, and asset goes up with a debit. And what else do I have more of? Sales. Revenue goes up with a credit. Let's suppose it is a credit card sale. Anybody work at a place where you accept credit cards? Let me tell you what used to happen, because I worked at a bank a long time ago. Businesses, they used to have that little machine, I don't know what it's called, but I call it the cha-ching machine, where you put the credit card in it and then go chuk-chuk. You know what I'm talking about? You know, you've seen that, right? They still have them around in case your card won't swipe. Well, back when I worked at a bank, businesses literally would bring those signed slips to the bank and deposit them. They had an account. That's where they deposited those slips. And they got credit for them immediately. Not by the computer system, because we didn't have all that back then, but those signed slips got deposited into their bank account. The same thing happens today, but obviously technology takes care of that for us. I don't think anybody takes those signed slips and brings them to the bank anymore, but instead, automatically, when you accept a credit card for a customer and you ring up that sale, that money goes into your bank account, okay, automatically. So from a company standpoint, making a sale with a customer using a credit card is just like making a cash sale. We get all the money right away. So my journal entry is a debit to cash and a credit to sales. That's the good news. There is some bad news with that. What's the bad news that goes along with that? They charge you a fee. So at the end of the month, we would make a journal entry debiting an expense account, credit card expense, and crediting cash, because they're going to take that money out of my account, make my cash then go down. So from your standpoint, a credit card sale looks like a cash sale. So my first journal entry is a debit to either cash or accounts receivable and credit sales. My second journal entry is to update my inventory. What happens to my inventory when I sell it? It goes down. Part of it's gone. Inventory is an asset. Assets go down with a credit. My credit goes to merchandise inventory. My debit goes to a new account called cost of merchandise sold. And this is the first account we've had that's had a longer title. There's 4 words in there. I'm going to call it cost of goods sold. You may abbreviate that COMS or COGS, and I'm fine with any of that. The most important part to remember is that cost of goods sold is an expense. Doesn't it sound like an expense? Cost, doesn't that sound like an expense to you? So cost of goods sold is an expense. The amount of this entry is how much the merchandise cost me. So if I bought something for $50 and I sold it for $75, That first entry would be for 75. This second entry would be for 50. Cost of goods sold is a new account in the general ledger. We haven't had it until this chapter. It is an expense. Let's do an example. We sell 20 lightsabers to Yoda for $400 each. When we bought the lightsabers, we originally paid $150 for them. So we're selling them for $400. They originally cost me $150. Well, first off, how much in total? What is my total revenue I'm getting from selling the lightsabers? $400 each times 20 would be $8,000. The second number we need to know is how much did those lightsabers in total cost her when she purchased them? $3,000. $150 each times 20? $3,000. Those are the two numbers we need. $8,000 is going to be the amount of the first journal entry. $3,000 is the amount of the second journal entry. Well, let's make some entries. First off, let's assume it was a cash sale. What do I have more of? Cash. Cash is an asset, goes up with a debit. We're going to debit cash for $8,000. And what else do I have more of? Sales is revenue, and revenue goes up with a credit. So I have $8,000 more cash, and I have $8,000 more revenue. My second entry, which goes right in this same box for these same journal entries, okay, don't go to the next one, is to update the inventory. What do I have less of now? Merchandise inventory is an asset, goes down with a credit. The debit for that entry goes to cost of goods sold. So I'm going to debit cost of goods sold, and then I'm going to credit merchandise inventory. Debit cost of goods sold, credit merchandise inventory, and the amount of that second entry is how much it cost me, $3,000. How did I do on that transaction? Real good. I'm glad y'all didn't say pretty good. I think that's amazing. If I bought something for $3,000 and sold it for $8,000, I'd be pretty happy. How much did I make on that deal? $5,000. Now notice, $5,000 doesn't show up in my journal entries anywhere, does it? A little bit later on, we're going to prepare an income statement. And on the income statement, we're going to show my revenue of sales for $8,000 and my expense of cost of goods sold for $3,000. Revenues minus expenses says I'm going to have a profit, in this case then, of $5,000. We're going to call my net sales minus my cost of goods sold will be my gross profit. Profit's what I make by selling something for more than what it costs me. We'll end up calling that gross profit on my income statement. And you got both of those in the first box, right, on the page? Let's do the same transaction again. This time it was a credit sale. What do I have more of? More accounts receivable, an asset goes up with a debit. What else do I have more of? Sales, revenue goes up with a credit. What do I have less of? Merchandise inventory, an asset, yes. And when I sell that asset, it becomes what to me? An expense, and we call that cost of goods sold. So I have more expense of cost of goods sold, and I have less merchandise inventory and asset. So my expense goes up with a debit, my asset goes down then with a credit. How does that compare to the first set of entries we made? What's the only difference? Debit to accounts receivable instead of debiting cash. This time, Yoda pulled out his intergalactic Visa card. What do I have more of? Cash. To me, it's a cash sale. Okay, why is that? Because I get my money immediately. So I'm going to debit cash. I'm still going to credit sales. I'm still going to debit cost of goods sold. And I'm still going to credit merchandise inventory. What does that look an awful lot like right there? A cash sale. It's the same as a cash sale. So a credit card sale and a cash sale look just alike. However, there's a drawback with that credit card sale. At the end of the month, the Intergalactic Bank is going to charge me a fee. Now, we're going to assume that that fee is, I think I have 3%. That would be 3% of my revenue. So what do we have? $8,000 in revenue times 3%? Says they're going to zap me for $240. They're going to take $240 out of my checking account. What do I have less of? Cash. Skip a line. Credit cash is good. And the debit goes to an expense account, credit card expense or credit card fee expense. So the initial sale itself looked just the same if it was a credit card sale versus a cash sale. But with a credit card sale, we get zapped for that fee at the end of the month, debiting the credit card expense and crediting cash. Let's move on and talk about sales tax. Something we all know and love, right? If I were to make a sale here in Lexington County, I think is what I'm in, and it's a $100 sale, would I simply collect $100? No. How much would I collect? $107. How about that extra $7? Is that your money to keep? No. Who do you owe it to? The government, state government particularly, and they split it between the state and the county. So how does that sound like? I've got some money, it's not mine to keep, I owe it to somebody else. What kind of an account does that sound like? Some sort of a payable. If we collect sales tax when we make the sale, we're going to change my first journal entry only. That second entry doesn't change, the first entry changes. Let's suppose it was 107. I'm going to debit cash or accounts receivable for 107. I'm going to credit sales for my revenue portion only of $100. The other $7 credit goes to sales tax payable. It's a liability because I got some money. It's not mine to keep. I owe it back to the government. Down the road, I got to pay that, right? I got to pay it. That would require an entry. It's on your handout, but what do you think it looked like when we pay our sales tax? Debit what? Sales tax payable. Why? To get that liability off of my books, good, and credit what? Cash. Do I have an account called sales tax expense? No. Is that sales tax an expense to me? No. Who is it an expense to? The person who's buying it. Let's do an example. When we sold 20 lightsabers to Yoda for $400 each, remember that one a minute ago? That was the $8,000 entry. We were required to collect 7% sales tax. Well, 8,000 times 7% says how much sales tax are we going to collect? $560. Let's make a journal entry. Again, we're making this sale on account. How much sales tax? $560. Okay, and it was a credit sale. What do I have more of? Accounts receivable. How much accounts receivable do I have now? Good. 8,000 plus the $560. $8,560 is going to be my debit to accounts receivable. What else do I have more of? Sales. But how much was my sales? Just 8,000. Is that other $560 my money to keep? I wish. You get in trouble to do that. Instead, I got some money and I owe it back to the government. All right. What do I have more of? Sales tax payable. Not my money to keep. I owe it back to the government. Now, all I had us do was to write down the first journal entry. We would still make the second entry, just somewhere on the side, pencil down, still need to debit cost of goods sold and credit merchandise inventory. So just jot that down. We still need to debit cost of goods sold and credit merchandise inventory. I just didn't give you enough info to do that right now. Let's move on and talk about sales discounts. We talked about discounts a minute ago, didn't we? That was when we bought something and the vendor offered us a discount to get us to pay them in a timely manner. We could be on the other side of that transaction. We could be the one selling the item, and we might offer our customer a discount to pay us in a timely manner. So what is a sales discount? It's when I've made a sale to a customer on account and we offer them a discount as an incentive for them to pay us earlier. Why would we offer them a sales discount? We need our money now, so we can pay our bills and pay our employees and buy more merchandise and all that good stuff. We'd rather have our money now instead of later, and we might be willing to pay customers a discount in order to get that money earlier then. Purchase discounts and sales discounts result from the same transaction. If I offer you a discount as an incentive for you to pay me earlier, to you, you'd call that a purchase discount. To me, I would call it a sales discount, just the opposite party's perspective. A sales discount is recorded only if the customer pays in a timely manner and takes a discount. Sales discounts are recorded in a brand new account called sales discounts. It is a new type of account to us, though. Sales discounts is a contra account to sales. So sales is revenue, which means sales discounts is a contra revenue account. Now, we've had contra accounts before, haven't we? We had one, what was it? Accumulated depreciation. And the rule we said with a contra account is, number one, they always have the opposite balance of what they're contra to. So that's why accumulated depreciation was a contra asset. Assets have a debit balance. The contra asset then has a credit balance. This is a contra account of sales. Sales has what sort of balance to begin with? Credit. So its contra account is going to have a debit balance. The other key feature about a contra account is it always gets subtracted when we prepare the financial statement. So when we go to prepare the income statement, we are going to subtract sales discounts from our sales. Okay? So the opposite balance of sales, it'll be subtracted from sales. Wherever sales goes, sales discounts is right after it, and it's going to be subtracted. What if a customer takes the sales discount? Let's suppose they owe me $100. They can take a $2 discount, which means they're going to pay me $98. So they pay me $98. They owed me $100. They're taking a $2 discount. What do I have more of? Cash. How much more cash do I have? $98. So I'm going to debit cash for $98 to make it go up. What do I have less of once they pay me? Accounts receivable needs to go down. But in that example, how much does accounts receivable need to go down by? Not $98, but by $100. Why is that? Well, we need to get it off the books completely, what they owe me. We credit accounts receivable for $100. To make it balance, I need a $2 debit. That $2 debit goes to sales discounts. So I would debit cash for 98. I would debit sales discounts for 2. I would credit accounts receivable for 100. I'll throw this in just it gets a little tricky on sometimes. What if we sold them $1,000 worth of merchandise in accounts and they brought back $900? So they only are paying me for the 100. When they go to calculate the discount, can they take the discount off the 1,000 or just off the 100? Just off the 100. But when you're calculating the discount amount, don't include the sales tax. Okay, so for example, with that last sale, we had the $8,000 sale. Let's figure the discount only on the $8,000, not to include the sales tax. What if the customer doesn't take the sales discount? Well, that takes us back to Chapter 2. Debit cash, credit accounts receivable. It doesn't show up anywhere then. All right, well, this time, Princess Leia sells 3 droids to Java on account for $2,500 each. She originally paid $1,000 each when she bought them. Terms are $115, net $60. The first thing I want us to do is to figure out what is the amount of my sales revenue. What is my sales revenue in this example? $7,500, $2,500 each times 3, $7,500. And while we're at it, let's figure up in total how much do those droids cost her. $3,000, $1,000 each times 3. Record making the sale. It's a credit sale. Don't have to worry about the sales discount yet. Do you even need to worry about the terms right now? No. Only when they go to pay me. So right now, I want you to do, we did this a couple minutes ago, record making the sale. It's a credit sale. What account did you debit? Accounts receivable, good, to make the asset go up. What did you credit? Sales. In addition, what account did you debit? Good. Cost of merchandise sold, cost of goods sold. And what did you credit? Merchandise inventory. 2 journal entries required to record every single sale. Okay. The first one is for the revenue, what I got for selling it. The second one is for what that item cost me. How much of a discount can Java take if he pays within 15 days? 1%, right? 1% of the $7,500 says he can save how much? $75, do we agree? Well, let's see. How much is he going to pay me? Well, he owes me how much? $7,500. But he gets to save how much? $75. Says he's going to pay me $7,425. Now we have the 3 numbers that we need. He owes me $7,500. He's going to save $75. He's going to pay me $74.25. Let's make a journal entry. Assuming he takes the discounts. What do I have more of? Cash. How much more cash do I have? $74.25. That asset goes up with a debit. What do I have less of? Didn't sell him anything now. He's just paying me right now. Paying me what he owes me. What do I have less of? Okay, skip a line. Skip a line. I have less accounts receivable, right? I need to make it go down. How do you make accounts receivable go down? With a credit. But my credit to accounts receivable is going to be for how much? $7,500, the total amount. So skip a line in the middle. Why could I not credit accounts receivable for $74.25? It would leave a balance of $75 in my books. Looks like they still owe me $75. Do they really owe me anything? No. To make that entry balance, I need a $75 debit. It goes to sales discount. A contra account to sales. Sales goes up with a credit, so sales discounts goes up with a debit cash for what I get, credit accounts receivable for the total. The discount they take goes to sales discounts, a contra account to sales. You already answered this question for me. Again, you don't have to write this all down. You might just want to make a note or two, though. Why could we not just debit cash and credit accounts receivable for $74.25? It would leave a $75 balance in accounts receivable, looking like he still owes me $75, and he actually doesn't owe me anything at all. So that would leave a balance in accounts receivable that we're not going to collect because we're not supposed to collect. What if Java pays me on day 59 instead? How much will he pay me? $7,500. What do I have more of? Cash and asset goes up with a debit. And what do I have less of? Accounts receivable, and asset goes down with the. So if he doesn't pay in a timely manner, he doesn't take the discount. It doesn't show up anywhere. Let's move on to sales, returns, and allowances. Now, we talked about returns and allowances a while ago, the beginning of today's lecture, didn't we? We talked about purchase returns and allowances. Now, remember, a purchase return is where I bought some merchandise to resell, and I took it back. A sales return is that same transaction, but from the opposite party's perspective. I bought something from you, and I didn't like it, and I took it back to you. To me, it is a purchase return, but to you, it is a sales return. Okay? Opposite party's perspective. An allowance, again, same idea. We sold something to a customer. If they don't like it, they agree to keep it, though, if we reduce the amount that they owe me. If the customer's already paid us, we got to give them their money back. If they haven't paid us yet, we're going to reduce the amount that they owe me instead. So a sales return and a purchase return both result from the same transaction, but from the opposite party's perspective now. Sales returns will be recorded also in a brand new account called Sales Returns and Allowances. It is again a contra account of sales, which means what? It's going to have a debit balance. It's going to follow sales. Wherever sales goes, Sales Returns and Allowances comes right after it, and it's going to be subtracted from sales on the income statement. To me, it kind of seems logical. If I sold something to a customer and they brought it back, it kind of seems like we ought to debit sales, doesn't it? Because we credited sales when we sold it to them. If they brought it back, it seems like why not debit sales? The reason we don't is it gives us an idea of how much of a problem we have with customer returns. What if I told you this? My sales this month were $10,000 and my customers brought back $9,000. Now, if I put both of those into one account, I would have, what, a credit of 10, a debit of 9. I would show $1,000 in sales. If I looked at that figure, I would think, well, our salespeople sure aren't working very hard, right? Is that really the problem that I have? Is that my sales force isn't working hard? What's the problem I have? I'm selling junk. There's something wrong with my product. It's not that I'm not selling that much. There's something wrong with it. And I can tell that if those are in separate accounts. The sales returns are in one account, the sales are in the other account. So that's why we put them in separate accounts. So both sales returns and allowances and sales discounts are contra account to sales. They have a debit balance. They follow sales wherever sales goes, and they will be subtracted from sales when we go to prepare our income statement. To record a sales return takes 2 journal entries. Just like recording a sale took two journal entries, a sales return also takes 2 journal entries. 2 different amounts. The first entry will vary depending upon whether it was a cash sale or a credit sale or a credit card sale. What if the customer hasn't paid me yet? We made a credit sale to them and they haven't paid me yet. The first entry is to record giving the money back to the customer. Okay? If they haven't paid me yet, will we give them cash? No. Instead, I'm going to make my receivable go down because they don't owe me as much anymore. The debit for that entry doesn't go to sales, but goes to that contra account called Sales Returns and Allowances. My second entry updates my inventory. Again, the assumption the customer brings the stuff back to us, we put it on the shelf, and we sell it to the next customer. There's nothing wrong with it. What do I have more of? Well, I have more inventory. Inventory is an asset, and assets go up with a debit. My credit's a little bit odd in this entry. My credit goes to cost of goods sold. Now, I say that's a little bit odd because what type of an account is cost of merchandise sold? An expense. When we credit an expense, we make it go down. Is that common for us to make expenses go down? No, really, only in closing entries is the only time we've done that. Why are we doing it now? Well, when we sold that merchandise to the customers originally, we said it was an expense to us. But when they bring it back to us, well, we've got to cancel out that expense that we recorded in the original entry because we didn't end up selling it to them after all, did we? So we are canceling out the expense recorded in the original entry. So my journal entry, again, let's do an example. Princess Leia sold those droids to Jabba. She sold them droids for $2,500 each, and they cost her $1,000 each. She gets 2 of them back. Jabba didn't like 2 of them. He brings them back to her. Okay. How much money are we going to give him back? $5,000, $2,500 each times 2, $5,000. What is the cost to us of the droids that she returned? $2,000. $1,000 each times 2, $2,000. So we're giving him back $5,000. Putting those droids back on the shelf cost me $2,000. Let's assume Jabba has not paid for these items yet. Has not paid for them yet. Will we give him his money back? No. Instead, we're simply going to reduce the amount that he owes us. So let's come up with our first journal entry. I'm going to debit my contra account of sales, returns, and allowances. What will I credit? What do I have left off? Accounts receivable good. Why not cash? Well, he hadn't paid me yet, so I'm not going to give him his money back. Instead, the amount that he owes us has gone. That entry is for $5,000. All right, the amount that he paid for those items when we sold them to him. The second entry puts the inventory back on my books. What do I have more of? Merchandise inventory is an asset, and it goes up with a debit, so we're going to debit merchandise inventory. My credit is what's a little bit odd. My credit goes to cost of goods sold. Cost of goods sold is an expense. When we credit it, we're making it go down. Why am I making it go down? Well, whenever I sold those droids, I recorded them as an expense. If he brought them back to me, I need to cancel out that expense that I recorded in the original entry. Flip back to page 15, and I want you to compare the journal entry for the return to the journal entry for the original sale. Tell me how they compare. Almost flipped, almost reversed, right? Can you tell me one account that is not exactly reversed one for one? Sales. In the original sales entry, we credited sales. In the return, do we debit sales? No, but we debit sales, R&A, returns and allowances instead. So the entry for the return is almost the exact opposite of the entry for the sale. The only difference being that instead of debiting sales, we debit sales, returns, and allowances instead. So I think that makes it easier. If you know how to record the sale, you're going to remember that the sales return is going to be the opposite. The only exception to that is that we're going to debit sales, returns, and allowances. Same transaction, but this time Job had already paid him. Will we give him his money back? Yep, we got to. What account do I debit? Sales, returns, and allowances. Very good. A contra account to sales goes up with a debit. Do I still credit accounts receivable? No. What do I credit instead? Cash. Good. Do I still debit merchandise inventory? Do I still credit cost of goods sold? So the only difference between this transaction and the previous one is we have to actually give them money back this time. We have to give them cash back. 2 journal entries to record a customer return, just like we had 2 journal entries to record a sale. The journal entries for the return are the opposite of those for the sale, except sales becomes sales, returns, and allowance.